Hello and welcome to this module where we are going to be discussing key performance indicators in stock management. Before we discuss the key performance indicators in stock management, let's discuss briefly what we mean by key performance indicators in general. When we talk about performance management in the workplace, as we evaluate individuals in their job positions, there are two terms that usually go together. These are KPAs, which are key performance areas, as well as KPIs, which are the key performance indicators. The KPAs are the areas of the business or the organization for which you as an individual are responsible. Success in these areas also means you have been successful in your job. So if you are responsible for stock or inventory management, that is your key performance area. The key performance indicators are now those things that can be measured to demonstrate how successful you were in your key performance area. For example, if one of your key performance areas is profitability of the company, the things that can be measured to indicate how successful you were, they could include the revenue or the gross profit margin, because these are to do with the profitability of the organization. When it comes to inventory management, there are quite a number of key performance areas, but we are going to look at 10 of the most common KPIs. As we go through these KPIs, I would like you to concentrate more on the central meaning of each KPI rather than on the formulae that are involved in calculating them, because it is not every organization that wants to calculate these indicators, but you would love to understand what each one of them means so that you can put effort to improve in each of those areas. The first KPI is called inventory turnover or days on hand. This KPI measures the number of times that inventory has been sold and replaced in a given time period. If the turnover is low, the company either has too much stock or too few sales. There are two formulas for calculating the inventory turnover, which are cost of goods sold divided by the average inventory, or the total sales divided by inventory. So what this KPI is basically saying is how quickly do you need to replace stock on the shelf. The fast moving items are the ones that are being sold out, and you must replace them as soon as possible. So in a supermarket business, for example, there are certain products that have to be replenished on a daily basis. Some are replenished weekly, then you get others monthly. Others are only replaced twice a year. This is because of the different levels of inventory turnover. So we are saying that if your turnover is low, it means either you are having too much stock, so in other words, you are not having to buy that often, so you have overstocked, or else you are having too few sales, so not enough people are buying, so you do not have to replace the stock often. The next KPI is called average days to sell inventory. This is a measure of how long it takes to turn inventory into sales. So in other words, after we have bought our inventory, on average, how long does it take before that inventory has been sold? So this KPI varies from one industry to the next, depending on what you are selling. The large and expensive items, they move slower than the cheaper and smaller items or perishables. That is why a person that is selling milk will sell more units than a person selling computers, and a person selling computers will sell more units than a person selling tractors, because the bigger the items, the slower they move. The formula for calculating average days to sell inventory would be the total inventory divided by cost of sales multiplied by 365. Then the next KPI is called average inventory. So this KPI is used to estimate the amount of inventory your company has on hand during a particular time frame. So it is the average stock holding during that period. So the goal of this KPI is to avoid having too much stock or overstocking, and also avoid running short of stock, in other words, understocking. So we need to keep a relatively constant flow of inventory in and out. So the best inventory manager is the one that buys the quantities that are needed, either in production or for sales, so that the total amount that comes in will be equivalent to the amount that is going out. To calculate the average inventory for a single month, you take the opening inventory, you add the ending inventory, then you divide by 2. That gives you your average inventory for that period. The next KPI is the holding costs. So this KPI measures the costs that are related to storing unsold inventory. This includes the cost of damaged and spoiled goods, as well as the cost of storage space, labor and insurance. To reduce holding costs, designate a reorder point. So in other words, you need to ensure that you have got minimum stock being held at hand. You must only hold sufficient stock, either for consumption internally or for use in the factory. This is the reason why some use just-in-time procurement, because with just-in-time you avoid or you minimize the quantity that you keep on hand. You only order so that the goods arrive just in time to be used in production, or just in time to be delivered to the client who has ordered the items. Another very important KPI is called stock out. So this KPI is useful to indicate to you how many times a client came asking for something and they could not find it. So in other words, it tells you the number of times that the demand could not be met because of the absence of required inventory. So for you to record this KPI, each time that a client asks for a product that was out of stock, you need to write it down. So the number of times that that item was out of stock will then give you the indication of the stock out. Another KPI is called service level. we use this KPI to calculate the amount of stock that we need in order to avoid a stock out. In other words, to avoid running out of stock. So this requires a compromise between the cost of inventory as well as the cost of a stock out. So we are trying to balance our supply and demand so that we don't overstock and we also do not understock. This is where the use of safety stock comes in. In other words, generally you are keeping just enough stock to meet your requirements, but you keep another extra quantity just in case there is an unexpected increase in demand. So you are able to meet that unexpected demand using your safety stock. Another important KPI is called lead time. This KPI is an important element of supply chain management and the inventory control process. So to calculate the lead time, we need to take the sum or the total of the time that it takes a supplier to deliver goods after you have ordered. So we take the total period from the moment we identify the need, we place the order, the supplier delivers, up to the time that we receive those goods. So that total time from identifying the need to receiving the goods, that is what we are referring to as the lead time. If we have time, we will discuss more definitions for lead time, because there is lead time for supply of raw materials. There is also lead time for production of items within our factory and so forth. So all those lead times, they are key performance indicators. Another KPI is the rate of return. So this KPI tracks and rates the percentage of orders that are returned to suppliers and need to be restocked. Equally important is tracking the reason for the returns so that you can address any problems in the supply chain. This will also help identify key trends that might prevent future costly returns. So what we are talking about here is the situation where a supplier sends items to you. You discover either they are wrongly supplied, they sent you the wrong part numbers, or they sent you items that are defective and you have to return those items to the supplier. So that is what we are referring to as the rate of return. So if you are returning items too often, that is not a good indicator. So you need to reduce the rate of return to almost zero, or to as close as zero as possible, because every return is costly. Then another indicator is called inventory accuracy. So this KPI measures the accuracy of your stock records, either in your books or in your database, against the physical stock on the shelves. So in other words, how accurately do your records represent the actual physical stock? So many times when you do your stock take, the level of variance is what is giving this inventory accuracy. When your records are not accurate, you might end up placing orders for items that don't need to be ordered, or you might not order something that is already gone well below its reorder level, but because your records are not accurate, they are not telling you that it is time to order that item. So those situations can be quite costly for your organization. We've got another KPI called perfect order rate. This KPI is the ratio of orders that fulfill the right delivery place, the right product, the right package, the right quantity, and the right documentation. A high perfect order rate can lead to increased customer satisfaction. So in other words, we are defining a perfect order to say when a client orders something from us, when we deliver that order, how often is it going to the wrong place? How often is it the wrong product? How often is it in the wrong packaging? How often is it in the wrong quantities? And how often does it go with wrong documentation? So a measure of accuracy in each of these areas gives us a perfect order rate. And the more perfect your record is, the more satisfied your clients will also be. So this list of 10 KPIs that we have been looking at, they can seem so daunting, but you need to choose the ones that make the most sense for your organization, and know that you don't need to implement all of them at once. So I presented all of them so that you can be able to identify which ones make the best sense in your environment. And if you are new to stock management or to these KPIs, you need to consider starting with tracking of inventory turnover. This is a relatively simple calculation that will allow you to measure how well your inventory is performing against your cost of sales. By choosing the KPIs that fit your business needs and tracking them over time, you may begin to recognize patterns that will help you figure out how to improve your inventory management process and ultimately transform your business into a highly efficient organization. So the reason we measure KPIs is to help us to improve our operations so that we become more efficient and more effective in our stock management. In the next module, I'm going to introduce the concept of multidimensional data modeling that can be quite useful in putting together an effective stock management system. So let us meet in the next module.